The financial landscape in mid-2026 has revealed a clear divergence in how digital assets perform. While Bitcoin and major altcoins have spent recent weeks consolidating in a relatively flat trading range, a specialized network has separated itself from the broader market trend. Hyperliquid, trading under the ticker HYPE, recently pushed through new all-time highs, crossing the $62 mark, and this growth represents a year-to-date gain of over 134%, solidifying it as one of the top-performing large-cap digital assets this year. To understand why this asset is decoupling from the rest of the market, we must look beyond basic price speculation. Today, we will examine exactly what Hyperliquid is, identify the unique engineering background of the team behind it, analyze the protocol's multi-million-dollar buyback engine, look at how it managed to outpace Bitcoin, break down the newly launched spot ETF, and finally, review its upcoming product roadmap. To evaluate the platform's price performance, we need to understand its structural shift. Hyperliquid originally launched as a decentralized perpetual futures exchange, which are trading contracts that allow users to buy or sell assets with leverage without an expiration date. However, the platform is actually built on its own specialized high-performance Layer 1 blockchain infrastructure. In 2026, Hyperliquid fully transitions from a simple trading application into a broad financial protocol. It has evolved into a multi-asset network supporting standard crypto assets alongside real-world assets, pre-IPO stock markets, and major commodities. For example, users can now trade traditional commodities like crude oil 24 hours a day, 7 days a week, natively on-chain. The HYPE token functions as the core economic anchor of this entire Layer 1 ecosystem. It is used to secure the underlying proof-of-stake network through staking, pay for transaction gas fees, and govern foundational protocol upgrades. By tying the token directly to the network usage rather than just exchange speculative volume, the platform ensures that as economic activity increases, demand for the native asset grows naturally. The operational approach of Hyperliquid stands in stark contrast to traditional cryptocurrency startups. The project was founded and is currently led by Jeff Yan. Yan has a deep background in advanced mathematics and quantitative finance. He won a gold medal at the International Physics Olympiad and graduated from Harvard University with a degree in mathematics and computer science. Following his academic career, he worked as a quantitative trader at Hudson River Trading, a prominent high-frequency trading firm, before transitioning full-time into decentralized infrastructure. What makes the team unique is their commitment to structural lean segregation. While most crypto projects raises tens of millions of dollars from venture capital firms, Jeff Yan completely self-funded Hyperliquid from day one. This decision prevented early equity dilution and allowed the team to build without outside pressure. Furthermore, the entire global protocol is managed by a core team of only 11 people. Roughly half of them are back-end engineers. The project does not maintain a traditional marketing department or a corporate business development team, relying entirely on product performance and organic user adoption to capture market share. The most significant fundamental driver behind the recent token appreciation is the platform's automated revenue recycling model. According to recent data from financial analysts, Hyperliquid has generated over $255 million in revenue year to date, making it the highest fee-generating independent protocol in the digital asset space. The platform is currently on pace to secure an annualized protocol revenue between $800 million and $1 billion. Unlike traditional exchanges where fee revenue is retained exclusively by corporate executives or venture backers, Hyperliquid's tokenomics direct approximately 99% of all network trading fee revenue towards structural open market buyback program. To date, the protocol has accumulated over $1.16 billion in total trading fees, which are systematically routed through its assistant fund to repurchase HYPE tokens directly from the open spot market. This creates a consistent structural buying pressure that scales directly with trading volume. When market volatility increases and platform volume surges, the protocol automatically executes larger market orders to buy back its own native tokens, heavily reducing the available circulating supply on exchanges, and this worked both in bear and bull markets. To understand how HYPE managed to sharply outperform Bitcoin this year, we have to examine a broader structural shift in global trading volume. Over the first 4 months of 2026, trading volumes on top centralized exchanges fell roughly 34%, dropping from an average of over $7 trillion down to $4.6 trillion. At the same time, decentralized perpetual exchanges saw their transaction volume increase significantly, reaching an average of over $611 billion per month. Hyperliquid captured the vast majority of this migration, controlling over 55% of total value locked across the entire decentralized perpetual futures sector. This immense market share resulted in nearly $190 billion in trading volume on Hyperliquid during the month of April alone, placing it among the top 10 financial trading venues globally across both centralized and decentralized markets. This massive influx of trading activity triggered the automated Fee Buyback engine, which forced short sellers to capitulate. Recent data showed over $37 million in short liquidation in a single week, creating an upward price squeeze that accelerated the token's outperformance against a consolidating Bitcoin. The fundamental buyback pressure has recently been matched by traditional Wall Street capital integration. In mid-May 2026, institutional asset manager officially launched its first Hyperliquid ETF on United States Stock Exchange. On May 12, 2026, 21 Shares US debuted its Hyperliquid ETF, trading under the ticker THYPE, which is designed to track the FTSE Hyperliquid Index and offer regulated exposure to institutional investors. This was immediately followed by Bitwise Asset Management, which launched its own Hyperliquid ETF under the ticker BHYP on the New York Stock Exchange ARCA platform. Bitwise introduced a unique financial model for this fund, announcing that it will permanently dedicate 10% of all corporate management fees collected by the ETF to directly purchase HYPE tokens on-chain. This token will be held directly on Bitwise balance sheet and stacked to secure the network. Within their first 7 days of public trading, this spot Hyperliquid ETF attracted over $54 million in net cash inflows, with trading volume accelerating rapidly as traditional institutions look for high-yield blockchain primitives. Additionally, tracking data revealed that institutional firms like Grayscale has actively accumulated HYPE, purchasing over $34 million worth of the token within a single week to back their investment vehicles. Looking closely at recent infrastructure updates, the expansion of the protocol feature set continues to drive capital retention. Following the successful deployment of Hyperliquid's Improvement Proposal 3 or HYPE 3, which allowed users to natively launch independent tokenized markets, the network is now rolling out HYPE 4. HYPE 4 introduced fully decentralized prediction markets directly into the Hyperliquid user interface. This upgrade allows traders to express views on real-world outcomes that traditional perpetual contracts cannot capture. While prediction markets generate lower direct fee rates compared to high-leverage perpetuals, the addition prevents capital rotation, keeping assets completely consolidated within the Hyperliquid ecosystem. Furthermore, Bitwise leadership recently stated that the broader financial market is still caught in a fundamental pricing error regarding Hyperliquid. Most market observers still treat the protocol as a simple cryptocurrency derivatives exchange, completely overlooking its ultimate trajectory as a unified, high-speed, decentralized blockchain network capable of hosting global financial assets. The market outperformance of Hyperliquid over Bitcoin offers an educational case study on the importance of real revenue generation and smart tokenomics. By combining an elite self-funded engineering team with a model that routes 99% of high trading fees back into asset buybacks, the network built a resilient foundation that handles open market demands smoothly. While its short-term price movements are amplified by spot ETF inflows and future market liquidations, the long-term success of the protocol depends on whether it can successfully scale into a global multi-asset layer 1 network. So thank you for watching this objective data breakdown. If you appreciate clean, informative financial analysis free of market hype, please consider subscribing to the channel. Share your perspective on decentralized infrastructure in the comments below, and I will see you in the next video.